We have kindly with us today Nick Purves, who is the fund manager at Temple Bar Investments, to take us through the next presentation. Nick, over to you.
Great. Thank you very much. So yeah, 20 minutes or so from me on Temple Bar Investment Trust. Obviously quoted in the UK, around market capitalisation around 800 million pounds, that sort of number. So again, I'm going to talk about the long-term benefits of a value investing style, which I suspect is a message you've heard repeated already this morning. And I think we'll start here just by, I think, really just trying to remind investors of the importance of buying at low valuations, and how there is enormous amount of evidence to show that starting valuation is the biggest determinant of future investment return. And I suppose it's fairly commonsensical, but if you buy at a low valuation, you should normally expect to receive attractive investment returns, and if you buy at a high valuation, then you should normally expect to see much more muted investment returns. And again, it's all pretty commonsensical stuff, but it's amazing in the stock market how often people forget that message. The chart here simply shows this is actually the US market. Each blue dot represents a month in time over the last almost 100 years. The axis, the x-axis, the horizontal axis, represents starting valuation, and the y-axis or vertical axis represents subsequent investment return. And you can see just how strong the inverse correlation is between the starting price that you paid and the subsequent investment return. So buy companies and buy stock markets, invest in stock markets where valuations are low is our mantra. We've adopted very much a value-driven style for almost 30 years. Actually, our longest-standing client is coming up to 24 years and running. We've more than doubled the index return over that 24-year period. And I suppose the message here is, not goodness, haven't we done well? The message here is that a value investment style adopted in a consistent and disciplined manner over a long period of time can add considerable value for clients. And we've been managing the Temple Bar Investment Trust for 4 years now, and obviously these are the principles that we have been putting into practice for the investment trust. We'll continue to put into practice, and we are confident that we can add considerable value for the trust over time. We need to be clear, though, however, obviously embedded in this 24-year track record, there are periods, and sometimes quite prolonged periods, of underperformance. You'll all know very well that there's no one investment style that adds value in each and every time period, and value investing is absolutely no exception. And so value investing, yes, very important. It's very important to have a strong valuation discipline, but it's also extremely important to have a long-term time frame to allow the benefits of a value-driven strategy to drive those excess returns. So bringing it back to today, so where is their value today? Well, the Temple Bar Investment Trust is a UK focused investment trust. 70% of its of the portfolio is invested in UK equities, and just shy of 30% is invested in overseas equities. The UK market, we think, looks particularly attractively priced at the moment. The chart on the left here shows the valuation attached to the UK market and compares it to the other stock markets of the world. And you'll see that the dotted line sitting at -20. And by the way, this is formed of a composite valuation metrics, if you like. So it's price to earnings, price to book, and dividend yield. And you can see this is a 50-year chart, and over the last 50 years, you can see that the UK market has traded a discount to the global average. That's perhaps not surprising, given the sectoral composition of the UK index. Obviously, some quite capital-intensive, lower growth industries do make up a large share of the index. So you should expect it to trade at a discount. That's only fair. But then look at the discount today. So we're sitting at between a 45% discount compared to the more normal 20% also discount. And then the chart on the right looks at the individual sectors and compares the valuation attached to the sector, that particular sector in the UK, and compares it to that sector and how it's priced globally. And again, you can see many sectors standing at very significant discount. So we think that starting valuations in the UK generally, not always obviously, but generally attractive. And this, all other things being equal, should set you up for some attractive returns in the future. There are many fund managers, actually us included, who've said that the UK market's been looking attractively priced for some time, and I think a perfectly justifiable riposte could be, well, yes, fine, we can see that the UK market is lowly valued, but what's going to change that? What's the catalyst to change that? And we think that recently, this year, last year, especially this year, there have effectively been two catalysts that we think have the potential to drive significant value creation in the future. One you're probably aware of, and that's been quite a significant pickup in the level of takeover activity. And this is the number of companies by year taken over in the UK market. Obviously, we're now in November 24, and already in 2024, the number of takeovers has exceeded the 2023's number. And important to reflect, when these takeovers can either come from corporates, normally overseas corporates, or they can come from private equity. But in both cases, they are companies or private equity investors who are putting real money to work because they see an underpriced valuation opportunity, and they obviously want to take advantage of that. We should note that in Temple Bar there have been 4 takeovers. The trust holds around 35-40 stocks in the portfolio, and 4 of those so far year to date have been subject to takeover bids, normally at around a 50% premium. So this has the potential. Increased takeover activity has the potential to drive continuing value for the trust's shareholders. Certainly won't go through all of these, but this is a list of the companies, and of course you'll be familiar with a good number of those. The most recent example perhaps being the ongoing takeover of Hargreaves Lansdown. The second potential catalyst is an increase in the level of share buybacks. And what is happening here is that companies are using the cash flows that they generate. And as things stand today, corporate profitability is pretty good. Not in every industry, obviously, but in most industries, profitability is pretty good. Companies are generating significant amounts of cash, and they are using a significant portion of that cash flow to buy back cheap equity. And what's sometimes not obvious from the outside is just how value enhancing that is for shareholders that choose not to sell into the buyback. So if a company is trading, the Temple Bar portfolio on average today is trading on a price earnings ratio of around 8 times. So that's an earnings yield of around, let's call it 12, 13%, that sort of number. And so that is what I'd say. So when companies are buying back their stock, they're able to put their cash flows to work at those sorts of yields, 12, 13% yield, with zero risk, by the way. And of course, what that does is that reduces the number of shares in issue, and of course means that every pound of profit the company generates next year is that much more valuable. So if a company buys back 5% of its shares in issue this year, it means every pound of profit generated next year is worth 5% more to the remaining shareholders. So that drives real earnings growth and therefore future dividend growth. So you can think of your total return effectively to you, the shareholder, as obviously your dividend yield. And you can either reinvest that to buy more shares, or obviously you don't have to reinvest it. And your shareholder buyback yield. That is the extent to which future dividends will grow as a result of reduced number of shares in issue. And you can add those two numbers together to get I suppose, what we will call a total yield. That's on this chart here. And you can see that the UK total yield is just over 6%. So that's a dividend yield of around 4% and a buyback yield of around 2%. And now I say that is real money being returned to shareholders. And of course, that 6% total return yield significantly exceeds the total return yields on a number of other markets. Now, of course, remember, this is the index, and of course, we're not buying the index. There are a good number of companies in the index which we think are fairly priced. So we think that the buyback yield on the Temple Bar portfolio would be much greater than that, and I'll come on to give some examples in a minute. But we would say the total yield on the Temple Bar portfolio is between 8 and 10%, that kind of number. We put in this chart. We think is interesting. We think there's a misunderstanding amongst many investors that in order to see very strong investment returns, you need to be invested in high growth companies with rapid revenue growth. And again, you all know there's a lot of excitement at the current time surrounding technology stocks, particularly in the US, and obviously particularly around AI. And I think what we are trying to show here, using the next example, is that you do not need to be invested in rapidly growing companies in order to enjoy very attractive investment returns. And we use the example of Next between 2020 and 2023. So that's a 23-year period, to show that the company's sales growth, and this is the bar on the left, averaged between 5 and 6%. So the company grew its sales probably a little bit more than nominal GDP. So yes, it's got a little bit of growth. It's growing roughly in line with the economy, but it's not what you would call a growth company. It took out some cost. It managed its margins well, which meant that profit before tax went up by more than sales as margins increased somewhat. So profit before tax increased by around 7%. But look at the earnings per share number, increased by over 12% per annum. And the reason it was able to do that was because the company over that 23-year period was incredibly disciplined, used its cash flow to buy back and retire cheap equity, buy back cheap shares. And what that meant was the number of shares in issue declined by around 50%, which meant that the earnings per share growth was double that of the profit before tax growth. So earnings per share growth around 12% per annum. Add on the dividend yield of around 3% per annum, and you get total return of 15% per annum. And because of the magic of compounding, you compound 15% per annum over 23 years, you get around a 2,500% return. So simply staggering returns from a company which has grown at a little more than nominal GDP. And it's these types of companies that we're looking to identify for the future. So companies that can generate significant amounts of cash, can compound value, are sensibly using that cash flow to retire cheap equity when other investors aren't interested, and therefore drive enormous amounts of value for the shareholders that remain loyal to the company. And again, bringing it back to the portfolio, here are 10 stocks in the portfolio today, all sizable positions in the Temple Bar Investment Trust. The table requires a little bit of explaining. So we're looking at the last 2 calendar years, so 2022 and 2023. The column on the left takes today's share price in the company concerned. Takes the 2022 and 2023 earnings or profits that the company generated, adds them together and divides them by today's share price to give you a 2-year earnings yield effectively. Columns 2 and column 3, well, what did the company do with those earnings? So NatWest generated around 26%, if I'm reading the number correctly, 26% of today's market capitalization in profits in the last 2 calendar years. Of that 26%, it returned 9 as a dividend yield, and it reduced its shares in issue by around 30%. So in the case of NatWest, the total shareholder yield, if you bought it today's share price, you would have received almost 40% of your initial investment back in the last 2 calendar years. Now, in the case of NatWest, the total shareholder yield is greater than the earnings per share yield because the company was actually returning excess capital. That, of course, is not sustainable for most companies over the long term. But nevertheless, just reflect on some of those shareholder yields there in the right-hand column. Let's say between 30, 35%, 20 to 30% also. And of course, these stocks do make up a significant portion of the portfolio today. So, we think a demonstration that the companies are lowly valued, hence the yields are so high. 2, obviously they're generating significant amounts of cash because that is the ammunition they need in order to drive shareholder returns. And 3, management teams that have the right mindset and are doing sensible things with the capital the company generates in order to reward shareholders. And I suppose, and then finally, before opening up to questions, I just bring it back to this is the top 10 holdings in the Temple Bar Investment Trust, makes up about 50% of the overall portfolio. And again, just look at the trust has performed well year to date. As I said earlier, it won't always perform well. It won't perform well each and every year, but this year has been pretty good. And yet, look at some of the price to earnings ratios, still single digit in most cases. So again, earnings yields of over 10% and some pretty attractive dividend yields to boot. Let's say from companies which are cash generative and driving significant amounts of value for their shareholders today. So all this leads us to believe that from the starting point of today, the trust portfolio can continue to generate significant value for its shareholders. And I was probably going to leave it there.
Nick, thank you very much. So we've got a number of questions, so we'll do our best to get through all of these. Now, the first one does go back to one of the first slides, Nick, and it's looking at the valuations of the UK. And Rupert asks, can you make a comparison to any other equity markets globally that have previously traded at such a large discount for such a long time, but have then recovered?
That's a good question. I think you can see that on going back to this chart here on the left-hand side, you can see that the valuation lows that we're seeing today, and you can have all sorts of debates about the reasons. Why is it the valuations are where they are today? Why is it that investors generally do feel so disgruntled? But I suppose if you look at the last 50 years, you can see that the sort of valuations that we're seeing today are unprecedented on a 50-year view. So I can't answer the question directly. What I can say, I have read that if you've systematically bought the market, and I'm not sure whether it relates to I think it does relate to the UK market. If you systematically bought the market at these types of valuations, the subsequent 5-year returns have always been well into double digits. So it's not a direct answer to the question. But hopefully it helps. I think the other thing I would just want to say is that a question we get a lot, obviously, is yes, the market's looked cheap. It's been looked cheap for a while. Why do you think it might re-rate? And I suppose, and of course, the honest answer is we don't know. No one. The rating attached to the market, whether it's the rating attached to the UK market or the US market, and many people have felt the US market has looked expensive for a long period of time. Ratings attached to the market, that's pure speculation. It's impossible to know how ratings might change over time. But what we would say is you don't need the rating to change for the stocks in the portfolio in order to enjoy very attractive investment returns. So back to that next example, people might struggle to believe that actually the rating attached to the shares did not change at all over that 23-year period, because all investors were receiving was basically their dividend yield, which of course is about 3% per annum, and their earnings per share growth, which is about 12% per annum. And so all that happened was that the shares followed the earnings. So they went up probably by around 12% per annum. And therefore, over that 23-year period, there was no change in the rating. You still got the 15% per annum. You still turn 100 quid into 2,500. Now, if you get a re-rating, then happy days. Then that 15% annual return becomes a 20% annual return. But you don't need it, and we certainly don't rely on it.
Thank you very much. So another question here from Alan, and it is about the pace of takeovers. And Alan asks, are you worried that the current pace of takeovers, in a dearth of IPOs, potentially will lead to a situation where there aren't any good value stocks available for you to invest in anymore?
Obviously a good question again. That's one we get. I mean, it's really not our place to feel worried about that. If we get to that point in time, then obviously we need to have a conversation with our clients, an honest conversation with our clients. But bear in mind that if we get to that place, our clients probably would have made a lot of money in the process. And so you could, yes, I mean, I totally get the question, by the way. You can have a philosophical debate as to whether, is it unhealthy for the market to see these takeovers without a healthy IPO pipeline? I think undoubtedly it is unhealthy for the market, but that's not our job. Our job is to make money for our clients. And if our clients have made a lot of money in the process, then we're happy. And if it means that they have to say, well, there's nothing left in the UK to go for, we have to go elsewhere to find value, that's great.
Thank you very much. So a question here from Jeremy, who notices that within the portfolio, there's Stellantis and VW, both of which has faced some serious challenges. The question is here, how are you seeing their performance at the moment?
Oh yeah, so I mean, we don't hold VW. We certainly do hold Stellantis. And the question is correct. Stellantis has been the most challenged stock in the portfolio year to date. I think that is a fair comment. I think we're not afraid of investing in cyclical industries. There is. You have to be. I think in order to access the low valuations that are on offer today, you have to be prepared to take on cyclicality. And yes, we believe for all the companies in the portfolio that the earnings power, the long run earnings power of the business, is in no way reflected in today's share price. But of course, you will get good years and bad years. And the question is absolutely right. The auto industry is going through a very tough time at the moment. You've got two things really. One is not only have you got a cyclical downturn, actually the years post-COVID were very good for the auto companies. 21, 22, 23, all very good years. A lot of pent-up demand and some supply constraints to boot, which created a very healthy pricing environment. And 24 is panning out to be a very difficult year. And there have been some big profit downgrades in the sector. So you've not only got the cyclical downturn, you've also got the whole move, the transition, the move to electric vehicles, the challenges that is creating for these companies, to a certain extent, having to run with dual cost structures. As a result of that, there's a lot of, it's not clear how quickly consumers will want to buy EVs. It's not clear the regulatory backdrop, how quickly the politicians are going to want to push the companies down the EV route. So it is a very difficult time for these companies. But we keep our eye on the long run earnings power of the business. So in the case of Stellantis, I mean, the numbers are just extraordinary, actually. Stellantis today is priced at 12 euros a share. Last year, it generated 6 euros of earnings. Okay, so just reflect on that. That's a historic PE of 2. You may remember, I don't know if you remember, so I'll go forward quickly enough. See Stellantis there, name number 5 on the list. It's generated, column on the left, 114%. So more than 100% of its market capitalization today in earnings in the last 2 years. Now, that was last year. These are operationally geared businesses. Today, the company's forecast, much more difficult year, the company's forecast to make 3 euros of earnings. So we're on the princely multiple now, 4 times earnings. We think the long run earnings power of the business is about 4 euros, that sort of number. And so, and therefore we believe, and we difficult to be sure as to what that might be worth in the stock market, but we think the company should trade at a high single-digit multiple. So where we're getting to is that, yes, we can see that the company's having a very difficult time of it. That is likely to run into 2025, but we see enormous long-term value. Even on a depressed level of earnings that we are today, the company is estimated to distribute €1 of dividend for 2024. So that's a dividend yield of around 8%. So remember, you're looking for around 8% per annum from your stock market investments. You're getting your whole investment back, in theory, your whole return back in your dividend. So if you get any capital growth on the share price, because actually conditions start to improve in the industry sometime next year, then that's just again icing on the cake. So we recognise it's a difficult time for these companies, but we're absolutely sticking with them because we think the long run earnings power of the businesses is not reflected in the share prices.
Thank you very much, Nick. We'll just squeeze in one last question here from Mitchell, who asked, when was the last time you felt as excited about the outlook for your portfolio as you do right now?
Good question. We tend to, the best time for performance. So if you look back at that, if you dissected that 23-year track record that I showed earlier, and you looked at, again, you isolated those times when valuations were particularly low. So in that 23-year period, that would have been, actually, for those with long memories, the technology bubble in 2000, so right at the beginning, 2007, 2001, 2002. The global financial crisis, for obvious reasons. Obviously, investors were driven by fear, sold down the shares perfectly decent companies to very low levels. Actually, we bought Next in the financial crisis. That's a good example of that. And then I suppose more recently, COVID, of course. And so those were three instances which are pretty similar to today, where there was a big disconnect in stock market valuations. And if you use those three prior periods as a starting point, you would be able to see, if you're able to dissect that performance record, that you enjoyed from those starting points a very sharp snapback in returns.